Since 2011, a $10,000 investment into Adobe Stock has turned into $135,000. That's up 13x over just over 11 years for 26% per year. But if you've been watching the stock this year, you know it's down close to 50%. So in the next 5 minutes, we're going to evaluate Adobe Stock and if this is an opportunity to potentially buy the dip or if the stock is still too expensive to buy. All right, so full disclosure, I share my portfolio on here all the time and I do full portfolio updates every week. So if you want to see that stuff, do me a favor, like the video, that helps people find it, and subscribe to the channel. But for disclosure, I am not a shareholder of Adobe. I'm not short, I'm not long, I'm just not a shareholder. I am considering it for my own portfolio, which I share again all the time on this channel. And here it is if you want to take a screenshot and see my positions. All right, so this is Fast Graphs. I'm a paying subscriber to this software, and this is Adobe's chart, right? We are currently looking at price to earnings and the growth of their earnings over time. What should immediately stick out to you if you look at this chart is just that the stock was way up here at 688 at the end of 2021, and now it's dropped all the way down to 341. This blue line right here represents Adobe's average PE over this entire 10-year period. And what you can immediately see is that the PE got way out of whack in 2021 and is now under its historical average, or at least this 10-year average. Right now it's sitting at about 25, and it's normalized, its average PE has been 39. And what you can see here is over this entire period, the average earnings growth rate has been 16.7%. It's grown earnings per share from $2.35, had a bad year in 2013 and 2014, but since then it's grown earnings per share to over $12.48. And by the end of 2024, analysts are actually expecting $17.51 of earnings per share. So what happened to the stock price and drove the stock so much lower? Well, obviously interest rates have gone up, and so that has hurt all stocks, and we've seen it really bad in growth stocks. But then specifically what has happened is analysts' expectations for earnings have actually come down. So in 6 months, the expectation has come down from $16 to $15.30. And if we go out to the next year, 2024, the same thing has happened. 6 months ago, analysts were expecting earnings per share of $18.38, and now they're expecting earnings per share of $17.51. So when there's fears of a recession, fears of a drop in earnings per share, plus rising interest rates, that is what has devastated shares of Adobe and other companies as well. Okay, if we jump over to Everything Money, we can see market cap is currently $160 billion. Their revenue over the last 12 months has been $17.19 billion. Net income has been $4.8 billion, so a very profitable company. Profit margins 28% over the last 12 months, which is a little bit lower than its 5-year average profit margin. And then gross profit margin is sitting at 87.8%, which is just incredible. That's what's so beautiful about software businesses. If we jump up to their 8-pillar comparison, which is not so great for growth style stocks, but more better for value style stocks, but still it does have some good quality indicators, right? So the 5-year price to earnings ratio, they want it to be under 22 according to this checklist. It comes in high at 40. 5-year return on invested capital, they want it over 9%. This is fantastic, almost 27%. Revenue growth is positive over the last 5 years. Net income growth is positive over the last 5 years. Shares outstanding is actually down 5%. So that means they're actually buying back more shares than they're issuing with stock-based compensation. They want to see long-term liabilities to 5-year free cash flow of under 5. They come in at 0.95. This is, huge for just stability of the balance sheet and stability of the company. This company's not going anywhere in terms of bankruptcy, right? Cash flow growth over the 5 years is positive, and then the only other red mark or X it gets is 5-year price free cash flow. They want to see it under 22.5, comes in at 31, right? Now, that's great. We have an understanding of how we've gotten to where we are with Adobe stock price, but what we need to figure out is if it's a buy right now moving forward. And the way we do that is by looking at what analysts expect revenue, earnings, net income, and free cash flow margin to be. And then we're going to apply our own price to earnings ratio and price free cash flow ratios and come up with a low, a medium, and a high buy price. And I haven't done this yet, so I have no idea what it's going to come out as. All right, so these are analyst expectations, right? So on average, over the next 5 years or through 2026, analysts are expecting compound annual growth rate for revenue of 11%. They're expecting net income to increase by about 11% per year. They're expecting earnings per share to increase by about 11% per year. So what does that mean? That means that analysts are pretty much expecting the profitability metrics to stay the same as revenue grows about 11% on average over the next few years. Okay, and then in 2026, analysts are expecting net income margin to be 38% and free cash flow margin to be almost 44%. All right, so let's jump over and we're gonna build a scenario here. This is a 5-year analysis. We're long-term investors. We're gonna build a low scenario, a middle scenario, which this middle scenario pretty much has analyst expectations in here, and then a high scenario. And what I've done is I've dropped analyst expectations by 10 to 20% for the low scenario, and I've raised them by 10 or 15% for the high scenario. And so what we're trying to do is just get a range of where the stock price should be based off of a potential expected price earnings ratio and what analysts are currently expecting in a range, because we know it's never going to be right. And so this just gives us an idea of some probabilities, some things that might happen with the stock price. And so in the low scenario, we've got 9% revenue growth, 26% profit margin. I used the lowest profit margin that they have over the last 10 years just to be conservative. 38% free cash flow margin, did the same thing with free cash flow. A PE of 15, remember this is 5 years out, so the company's gonna be growing a little bit slower. And I wanted to be conservative with the PE number. In the middle scenario, we went with 11% revenue growth, 38% profit margin, 44% free cash flow, a PE of 18, price free cash flow of 18, and then a 10% annualized return. In the high scenario, we went 13% revenue growth, 38% profit margin, which is what analysts are expecting, 44% free cash flow margin, a PE of 25, which I think is actually pretty generous, but it's a drop from the trailing 12 months PE. So we'll see. That's a high scenario. So we do want to be a little bit generous with the high scenario. And then a price free cash flow of 25, desired annual return of 10%. So this is what kind of, if we wanted to get a 10% annualized return based off these scenarios, this is the price that we should be buying the stock at in each of these scenarios. And so according to this, the stock is currently overvalued. So current share price is $343. If you believe the low scenario to be true in terms of PE, you would pay $182. If you believe the mid scenario to be true in terms of PE, you would pay $333. So that's closer. So if you think this is realistic, 11%, 38, 44, and then a PE of 18, or maybe you think it should get a higher PE, then right now Adobe is right around where you'd be willing to buy it. And then the high scenario, if you believe 13% revenue growth, 38% profit margin, 44% free cash flow margin, a PE of 25, and a price free cash flow of 25, then you'd be willing to buy those shares all the way up to $473 a share, right? I don't think that Adobe is more likely to have a high scenario like this. I think especially because this PE is probably a little bit high from where it would deserve to trade in 5 years. So if we take that PE down to about 21 and we bring that sales growth rate down to about 11%, remember this is the average over the next 5 years, right? Then we get in line kind of with where the stock's trading now, and you'd be willing to buy it right under about 377, okay? So for me, for now, I'm not interested in owning the stock. It's a fantastic company. It could be interesting for a lot of people, but I'm gonna put a reminder to myself to check it out if it hits below 267. Thanks for watching. If this content was valuable to you, the best thing you could do to support the channel is to like the video, subscribe to my channel so you never miss an update. It really helps me grow. And let me know in the comments if you agree with this or not. And if you have any stocks you want me to run an analysis on, I would love to do that for you.